Good evening. I hope you are all keeping safe and healthy during these times. I would like to thank the entire investor community for the tremendous support shown during our IPO in February 2021. It was a proud moment for all of us. Today on the call, I am joined by Rajiv Mehta, CEO, Mr. Shashidhar, CFO, and the team from Orient Capital, our investor relations partners. We have uploaded our investor deck and results highlights on the stock exchanges and the company website. I hope everybody had an opportunity to go through the same. Since our company has just been listed and we are doing the entire earnings call for the first time, I would like to share a brief overview about our company, its journey and growth strategies going forward. Stovekraft Limited is a kitchen solution and an emerging home solution brand. Further, we are one of the leading brands for kitchen appliances in India and are one of the dominant players of pressure cookers and amongst the market leaders in the sale of freestanding hobs and cooktops. We are engaged in manufacture and retail of wide and diverse suite of kitchen solutions under our Pigeon and Gilma brands and propose to commence manufacturing of kitchen solutions under the Black & Decker brand, covering the entire range of value, semi-premium and premium kitchen solutions respectively. Our kitchen solutions comprise of cookware and cooking appliances across our brands, and our home solutions comprise various household utilities, including consumer lighting, which not only enables us to be a one-stop shop for kitchen and home solutions, but also offer products at different pricing points to meet diverse consumer requirements and aspirations. Our flagship brands, Pigeon and Gilma, have enjoyed a market presence of over 15 years and enjoy a high brand recall among consumers for quality and value for money. We manufacture and retail a wide and diverse range of affordable quality products under our Pigeon brand, including cookware, cooking appliances, and household utilities. That also includes consumer lighting. As a result of our co-branding initiatives for over 8 years with IOC Indian Oil, HPCL, and BPCL, to utilize the sale and distribution channel, our Pigeon brand has enjoyed a wide consumer outreach and continues to have a very high brand recall value. We currently offer a wide range of products such as chimneys or cooktop under the Gilma brand, which is targeted at the semi-premium segment. In addition to our established presence in the value and semi-premium segments through the Pigeon and Gilma brands, we have also entered the premium segment in 2016 pursuant to our exclusive Black & Decker branding license arrangement, which enables us to exclusively retail and provide sales and service in relation to the wide range of products such as blenders, juicers, breakfast appliances, small kitchen appliances, and domestic appliances in India under the Black & Decker brand. This agreement is valid up to 31st December 2027. Coming to our manufacturing facilities, we manufacture our Pigeon and Gilma brand products at our well-equipped and highly backward integrated manufacturing facilities at Bangalore, that is in Karnataka, and at Himachal Baddi, which enables us to control and monitor the quality of and the cost. Our Bangalore facility is spread over about 46 acres, and about 30 acres of the land is still available for future expansion. It has an installed annual production capacity of 38.4 million units with the capability to manufacture products in pressure cookers, non-stick cookware, LPG stoves, mixer grinders, LED bulbs, irons, electric irons, and induction cooktops. Our Baddi facility has an installed capacity of 2.8 million units per annum with the capability to manufacture products such as LPG stove and innerlit pressure cookers. These robust facilities with a constant focus on technology upgradation are equipped to manufacture a wide and diverse range of products, as well as several components used in our products. We propose to increase the level of automation at our facilities as we believe that this would enable us to achieve greater efficiency in reducing time taken for and the cost of manufacturing our products, from design to commercial production, and in-house testing and quality assurance processes, resulting in higher profit margins. For certain product categories and subcategories which do not enjoy economies of scale in India, we engage in sourcing from third-party OEMs, predominantly from the global arena. Our sourced products, we have a dedicated team to undertake inspection and ensures that such products are built to suit our specifications in terms of design and quality. Coming to our distribution network, we have a separate distribution network for each of the brands, Pigeon, Gilma, and Black & Decker brands. Further, there is a separate distribution network for the Pigeon LED products. Our manufacturing facilities in Bangalore and Baddi are well connected with 9 strategically located C&F. Additionally, we have 651 distributors in 27 states and 12 distributors for our products that are exported globally. The C&F agents and distributors are in turn connected with a dealer network comprising of about 45,400 retail outlets, which are driven through a sales force of 566 personnel. We have entered into commercial arrangements with retail chains such as Metro Cash and Carry for the sale of our Pigeon branded products from several of the retail outlets in India. Further, we have also entered into agreements with e-commerce platforms such as Flipkart for the sale of our products on their portals. Our Gilma brand products are sold through exclusively branded outlets owned and operated by franchises. There are 65 such stores spread across 4 southern states and 28 cities and towns, with a presence in the urban market in South India. Gilma stores are designed to be an experience store. We believe we have been able to leverage the distribution network of our Pigeon branded products and the brand recall value to enter the new segments and markets outside of India. We export our products which are manufactured by us to retail chains in the United States of America and Mexico. We maintain continue focus on the development of our brands and invest significantly our resources towards their growth and outreach. Further, our dedication to R&D, quality and customer satisfaction, our in-house servicing capabilities, and our own maintenance and service network also contribute to the market perception of our brands and products. With this, I would like to hand over to Mr. Rajiv Mehta, our CEO, to discuss the strengths of the company and the future strategies. Thank you.
Hello and good evening, everyone. Stovekraft Limited is a one-stop shop for kitchen solutions with a diverse range of products across consumer preferences and our consistent focus on quality and innovation with strong manufacturing and great backward integration. Stovekraft Limited has always remained focused on quality and innovation. That is one of our key strengths. We believe that quality is a prerequisite for a positive consumer experience and long-term brand loyalty. This philosophy has formed the foundation of the expansion and diversification of our product portfolio since our inception. Our focus on quality is maintained at all stages, right from the sourcing of raw materials, which is undertaken from manufacturers, to the product development and manufacturing stage, which is subject to a rigorous review and monitoring process. For products which are sourced by us from China, we have dedicated sourcing teams and quality assurance teams. They closely monitor the quality of such products. Our efforts to maintain the quality have always been well recognized and regarded in the industry. Over the years, we have focused on investing in product innovations that are most relevant to the consumer for our brand. We have added segments based on shifts in consumer preferences and market demand. We have a dedicated in-house R&D facility and have progressively increased our investment in R&D over the last few years. To further our efforts in innovation, we have also entered into tie-ups with foreign companies for technology enablement and tech know-how agreements. As a result of our focus on innovation, we developed the Super Cooker, which has a registered design and is customizable into products with multiple utilities. We have also developed the Super Storm Advanced Mixer Grinder with forced air cooling technology and the Infinity Glass Cooktop with a fastener-free body. We have a few upcoming launches too, which include the Turbo Chopper, the Feather Touch Mixer Grinder, the Personal Blender, and the Pro Chopper. We have a strong manufacturing capability with very efficient backward integration. We believe the scale at which we undertake the manufacturing of our products, combined with our raw material sourcing, packaging, transportation practices, and quality control, enables us to derive higher margins from the sale of our products. It is also one of the few facilities in India to have a fully automated roller coating line for the manufacture of non-stick cookware. Our manufacturing facilities are backward integrated. We have the ability to manufacture components such as bakelite handles, sheet metal components, molded parts, die-cast parts, molds, dies, and fixtures in-house for the manufacture of our products. We believe the backward integration of our manufacturing facilities has reduced our dependence on third-party suppliers and OEMs for such components. Both our manufacturing facilities are ISO 9001-2015 certified for implementing quality management systems. We have maintained a strong track record for growth over the years through expansion of our brand portfolio, distribution network, improved procurement costs, and increase in sales growth. Our operational efficiencies and efficient supply chain network has resulted in better control of operational expenses and thereby enabled rise in profits after tax. Further, we have been able to capitalize on our existing logistics supply chain network and backward integration manufacturing facilities to utilize our capital efficiently. Over the past few years, we have added manufacturing and warehousing infrastructure, scaled up our retail franchise operations, added a number of new product categories, and entered new customer segments. We believe that these initiatives have prepared a strong base for future growth. We are also continuously scaling up branding, promotional, and digital activities. Our widespread presence and scale of operations allows us to increasingly focus on branding and promotional activities to enhance our visibility in our category in the industry. While our consumer brands are well established and enjoy a high brand recall amongst our customers, we seek to continue to enhance awareness and customer loyalty through our promotion and marketing efforts such as increased advertising in print and social media, retail branding, product branding, and factory visits for our trade partners. We have substantial contemporary educational content and engaging brand associations. The digital platform and social media has enabled us to reach a wider audience and also customize our advertising offering to our prospective consumers. We believe that our customer-focused products and product information, along with a well-recognized brand, increase customer confidence in our products and influences our customers' buying decisions. We seek to utilize our research and development capabilities to develop new products to cater to evolving requirements of our large customer base and cover new customer segments. Being technology-driven enables us to gain a deep understanding of the market trends in the kitchen solutions industry, and shifts in customer preferences enables us to expand strategically and with great agility. Our next focus is on LED consumer lighting business. We will continue to introduce a wide range of LED lighting products for different end-use segments and expand to newer and broader geographies. Further, we are leveraging our manufacturing strength and have established a fully automated LED assembly unit for LED bulbs and batten manufacturing in our Bangalore facility. We are continuously increasing our export opportunities. With manufacturing and technological competence in non-stick cookware, we are globally competitive to cater to both the developed and developing markets. To expand our global reach through constant innovation and increase customer acceptance of our products in international markets. With this, I would like to hand over to Shashidhar, our CFO, to discuss the financials for the quarter and 9 months ended 31st December 2020. Thank you.
Thank you, Rajiv, and hello and good evening to everyone. Our company reported a strong growth for the third quarter and for the 9 months ended 31st December 2020. Revenues for Q3 FY21 stood at 295 crores versus 200 crores, registering a growth of 47% on a year-on-year basis. EBITDA has seen a strong growth of 160%, which stood at rupees 43 crores as compared to 16 crores same period of last year in Q3 FY20. We have seen an improvement of 630 basis points in our EBITDA margin on the back of volume growth led by good festivities, operational efficiencies, better product mix, and cost rationalization programs. Our EBITDA margin for the quarter stood at 14.5% as compared to 8.2% in Q3 FY20. The profit after tax for the quarter stood at rupees 33 crores versus rupees 9 crores in Q3 FY20. The PAT margin for the quarter stood at 11.4%, showing an improvement of 700 basis points compared to 4.4% in Q3 FY20. Now, coming to our performance, our revenues stood at 624 crores, vis-a-vis rupees 516 crores, same period of last year, registering a growth of 21%. EBITDA for the 9 months of financial year 2021 stood at 88 crores as compared to rupees 36 crores in 9 months of FY20, which registered a growth of 147% year on year. The EBITDA margin has also seen a healthy improvement of 710 basis points, which stood at 14% versus 6.9% in 9 months of FY20. Profit after tax for 9 months of FY21 stood at 62 crores as compared to 13 crores in the 9 months of FY20, recording a growth of 368% year on year. PAT margin stood at 9.9%, a stellar improvement of 730 basis points as compared to 2.6% in the 9 months of FY20. We are continuously working on our efficiencies, on improving our efficiencies. Our working capital cycle has improved from 54 days in March 2020 to 47 days as of December 2020. During the current financial year, the company has reduced its debt by rupees 134 crores, by about 93 crores through the IPO, the primary rise through the IPO, and rupees 41 crores from internal accruals. The company going forward plans to be a zero-debt company in the near to middle term. With this, we will now open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah, so thank you for the opportunity. My first question is, at the employee and the other expense, the pre-COVID base for us was about 190 crores, and there is a lot of variability in the last 3 quarters. What should be the number that we should look at on the employee and the other expenses side as we move forward?
Yeah, we should consider at the same level that we were at the last year. There has not been, there was some cut on our costs, both on our travel expenditure and the employee cost and the marketing cost. But going forward, we should consider the same level as the last year.
Anything specific about this quarter? Because, when we look at 190 crores last year and try to look at a quarterly run rate, the quarterly run rate that we see in this quarter is at least 20% higher. So anything specific you want to highlight?
So I think we are back at the same level for this quarter.
We are at about 60 crores in this quarter, and ideally it is 50 crore if you look at the last year's number on a quarterly basis.
There could be some skews in some costs in the different quarters, but on an ideal basis, while of course the first quarter and the last quarter contribute lower costs, and it is the second and the third quarter where we spend more on marketing. So on an average, it will be in the range of 45 to 50 crores a quarter. But yes, the first and the last quarter, the costs are lower than the second and the third quarter.
Perfect, sir. On the gross margin side, considering the material price rise, how do we see the gross margin here on, and what are your pricing actions?
So there are two things about the gross margin. One thing is, of course, if there is any cost increase, we pass it on. It takes about some time. It's only once in a quarter that we correct our prices. But otherwise, we are a cost-plus company and pass on any cost increase. We would not want to encash on that, but whatever is our cost increase, we pass on. But the second thing is, when we are moving more of our trading to manufacturing, it is adding some percentage points to our gross margin. So as we are moving from what used to be a 70% of manufacturing and 30% of traders, already so far we have already achieved this year 80-20. So we are at 80% of manufacturer and 20% of traders. That is also adding to our gross margin. And progressively, as we go on moving towards more of manufacturing, our gross margins also will see northwards.
Okay. My last question is, sir, looking at the buoyancy in the market, what do you think you should be clocking as sales for FY21?
Yeah, we are growing and there is a very good traction in the market. Overall, the market is seeing very high demand, and we believe that we will be able to grow at the current level.
Okay. And I missed the working capital cycle numbers which was shared in the initial comments. Where are we on the working capital cycle days?
Yeah, so
I think Shashi has mentioned about this. We have been improving continuously. So we were at about 54 days and currently we are at 47, but there is a continuous thrust on that, on improving this. So going forward, you'll see much better working cycle days.
Even better than 47?
Yes.
Okay. This is net working capital, right?
Yes, it's a net working capital.
Okay. Thank you very much, sir.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Shivaji Mehta from Nippon Mutual Fund. Please go ahead.
Thanks for the opportunity. Sir, in terms of the distribution network, if you could provide some color as far as, what could be our target in terms of the retail touch points, that we would like to be present in say, the next 2 to 3 years?
So currently we are at about 45,000 plus retail touch points across our three brands, which is LED, Black & Decker and Pigeon. Of the 45,000, Pigeon is about 33, LED is about 11,000 and 1,000 is for Black & Decker. Black & Decker and LED are present only in 9 states and 6 states respectively. Given that LED growth is possible through geographical expansion beyond the 6 states, we are planning to add more states. And as you can see, there are smaller retailers in LED, so the growth in LED in terms of numeric distribution and adding retail touchpoints will be much faster. When it comes to Pigeon, I think the universe is close to about 1 lakh and a half. Between that, we are at 33,000. There is scope in both numeric distribution and geographic distribution. As we grow, we believe that we will focus both on weighted average distribution as well as numeric distribution. So within lines with of our growth numbers, we will keep growing our distribution as well.
Sure. So on e-com, if you could provide some color, what is the contribution of the same as of now, and how do you really see this going ahead?
E-commerce is at 30% currently, and we believe that it will remain at between 30 to 35%, and so will that is how we see it for the next year at least.
Okay. Sure. And lastly, from my side, if you could just give us some color on the share of the OMC business as of now. I understand you are trying to reduce that contribution. So what could that be as of now?
We are moving towards zero. We are currently, of course, having some revenues from our oil company business, but we are moving towards zero.
Okay, thanks. That's all from my side.
Thank you.
Thank you. The next question is from the line of Rahul from Haitong. Please go ahead.
Yeah, hi. Good evening, everybody. Congratulations to the team on the good third quarter and 9-month performance, especially in the backdrop of the pandemic. Now, my question is, you have a very strong presence in the kitchen appliances, across small appliances up and all. how do you see the company in terms of the product portfolio over the next 5 years? Do you see yourself moving from kitchen appliance to the entire home appliances area, or you would prefer to stick to kitchen appliances only?
Yeah, you should consider us as a kitchen appliance solution provider. And of course, we are there in some parts of the home. Our thrust will be more towards the kitchen and kitchen solutions. But we also realize that within the channels that we operate, there is opportunity for the home. So there will also be some areas where we are getting into the home, like the LED bulbs. But primarily, we are a kitchen solution company.
Okay. And you've listed down a couple of products that you're looking at launching. Is there a pipeline that you have, over the next couple of years that you would like to hit?
Yeah, so I think innovation is a continuous process at Stovekraft. We continue, that is driven where we are towards where we are today. I think as in the overall the consumer behavior is also evolving every day and the needs are also evolving. So we continuously work on that. But the guidance is that we will be more towards the kitchen.
Okay. That's it. Thank you very much and all the very best.
Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead.
Yeah, thank you for taking my question. Sir, I missed one thing. You responded to the LED distribution numbers. How much that?
So LED has 11,000 plus retail outlets present in six states.
Okay. Sir, in that distribution only, as you had mentioned, you have a CNF agent as well as you have exclusive stores of Gilma. So your entire retail touch points were serviced through these CNF agents only?
So for LED business, we do not use CNF agents. We have super distributors. We build through the super distributors. From our mother warehouse, we directly ship to the super distributors. For pigeon general trade and modern retail, we use CNF agents which are spread across the country. And Gilma franchisees, our stores are also serviced through super distributors.
Okay, and how many super distributors do you have?
So for LED business, we would have 6.
And we have 3 for
Gilma.
Okay. Okay, fine. And also in the presentation, you talked about the huge opportunity in the export market. So which all products are there in the export market? And also, I'm just curious on that. We have a huge India market of this brown goods or kitchen products market. Why to venture in the the export market?
So for us, we have 2 types of export. One is, of course, the whole entire range of kitchen products that we export to the Indian diaspora wherever Indians are living. But more particularly to the developed world in the US, we work only with the retailers. And the only product category that we export is non-stick cookware. And by far, we are the largest exporter of this range of cookware, the non-stick cookware. And we believe that we can build a very strong relationship with all the retailers and then probably in the future have some kind of brand and distribution play ourselves there. And that is the strategy behind building this business.
And any ambitions for a company to be the percentage sales you are going to drive from export?
So we are at currently about 10% of our revenues come from export. And we believe as the company grows, it will be in the 10 to 15% range that exports will also, because exports at the moment are growing faster than the company. So we believe we'll be in the range.
Okay. So that will be in the same range what currently is. Second question is, as you had answered, also related to the strong growth in the coming years and also the current situation. I believe there is some pent-up, but can you give some more color on that from where, what exactly the driving the huge growth in the sector and as well as for you?
One is the category itself is growing, and that is giving us the opportunity to grow. And the channels that we operate, of course, the e-commerce channels are growing faster. And as a company, for us, that is a very important channel also. Since that channel is also growing faster, we are growing faster than the industry.
Any numbers, sir? How much the e-commerce channel is growing at, and what our growth rate in that channel?
So I can say that we are currently growing upwards of 50% on the e-commerce channel, and the company's growth number. So it is overall as a company, while we are growing, but the e-commerce channel is growing higher than the company's growth rate.
So is it fair to assume that e-commerce is taking a share of a brick and mortar, or there is category growth which is driving e-commerce? So I just want to understand if the market share shift.
So I can say that it is a mix of both. It's not that nothing would have leaked from the general trade to e-commerce, but then there are several areas where we were not very strong at all, particularly in the north and the east. And we have a substantial contribution coming from our e-commerce channels even in these areas. So we believe that is a pure new acquisition. Of course, there has been a shift in the consumer behavior itself. Some of the consumers would only prefer to shop online, and then so these consumers are whom we are catering to. We are continuing to grow even in our general trade channels.
Okay. Sir, last question. Out of your 45,500 retail outlets, how much are in the southern India?
See, there are two. I mean, of course, you can go by that number. We can give you, but basically the southern states we are more stronger. So the revenues from the number of dealers will be higher. So if you will want a breakup of these two, for our general trade, we are skewed more towards the south. We have a 55% contribution coming from the total revenue from the south, and the rest of the country is only giving us 45%. But when you combine all these three channels, that is general trade, e-commerce, and modern retail channels, we are a 45-55. About 45% of our revenues come only from the south and 55 from the rest of the country.
Okay. Thank you, sir. Thank you for taking my question. All the best.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Jeetu Punjabi from EM Capital Advisors. Please go ahead.
Yeah, thanks. Good, really strong revenue numbers. So my broad question is, can you give us some contours into what drove these numbers, and are these numbers sustainable? I mean, if I look at it over the December 19 numbers, it's almost a 50% growth. So a little bit of sense on what could be the next 2 or 3 or 4 quarters looking like from a growth perspective.
So for the near term, you can expect us to grow on similar lines because we see very high traction in the market also. And it's also our capabilities are enabling us to cater to the market. So we have our lines available and the capacity to cater to this. We are also expanding our manufacturing capacity. So both these should allow us to grow at the same levels that we are growing.
Okay. And a linked question to this is, what kind of resources would be you needing? I mean, do you need more capital, or do you need to hire a lot of people to get to these numbers, or do you think your current organization is well sized for that?
So on the manufacturing side, we are moving more and more towards automation. So we believe that this will lead to higher efficiencies and higher production rates. On the indirect manpower, it's not that just because the revenue number is growing, we need to add more people. We have spread up. We have a team that is catering to these sales across the country, from extreme north to south and west to east. And the management team is well capitalized to handle the current growth rate. So at the manufacturing, maybe there could be a slight increase in the number of people, but then more of it is driven by automation.
Okay. And on the cost side, I'm assuming the last couple of quarters were in a lockdown world. What do you think would be the incremental cost that would add up as a function of normalization over the next 6 or 12 months?
So yeah, the current quarter and the first quarter of the next year, I don't think they will be comparable because we had this very special situation, truncated March last year, and a larger part of the first quarter completely washed off. So I don't think these two will be comparable. But otherwise, I can say in the near term, the growth rates, if they were to be in comparable terms, would be still in the same range that we are currently growing.
So you think, if I see your numbers, you're doing 11-12% PBT margin, those kind of margins will sustain in your view?
I don't believe there's there's no other reason why it should be lower.
Okay. And one final question, if I may ask, is there something different and new completely relative to what you guys are doing? So I understand the broad vectors that you are largely in the kitchen appliances, and you're keeping adding new products, and you're working through the 3 channels and exports and driving growth. Is there something completely new and different that could play out over time, over the next 12 months, say?
Actually, our positioning itself is different from the listed peers. Both the consumer where we are, our brands are positioned, and also the way we function. So if you will understand from our numbers, see, we are at a lower gross margin number, but we are at par or better than our listed peers in the EBITDA and bottom line numbers. So it's a totally different operational efficiency and cost structure that we have.
Okay. And actually, one final number, what percentage is online sales out of the total revenue line?
It's around 30% now, currently.
30? Did I hear you right? Is it 30?
30, yeah.
Okay. Thank you, sir. Really appreciate this. Best wishes.
Thank you.
Thank you. The next question is from the line of Abhishek Daga, who's an individual investor. Please go ahead.
Namaste and congratulations. So actually, I had 2 questions. One is, in the North India, we see a very less presence of your brand. So will it be monetized over the time? And the second question is, the working capital requirement on the number of days will be less, so the cash flow is more, and the company is now generating profits. So will we get dividends as a retail investor?
So when you are talking about the North, of course, like Mr. Gandhi explained earlier, there is a concentration for general trade that 55% is South and the rest of India is 45%. So we will be focusing on growing the rest of the country. There is a huge opportunity for us to increase the number of distributors as well as the number of retail touchpoints in the North, East and West. So yes, there will be focus on making sure that our brand is present across the country.
Yes, Abhishek, we will definitely always want to excite our investors, and at an appropriate time, I'm sure we'll do the best that is in the interest of every investor.
Thank you very much, sir.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Pritesh Chedda from Lucky Investment. Please go ahead.
So just a follow-up on what will be the taxation going forward for the next 2-3 years?
Shashi, can you come in?
Yeah. So basically, the company has got carry forward income tax losses, as a result of which in the current financial year FY21, as well as a better part of the next financial year, we would not be paying any corporate taxes. We have now moved to a new regime. But yes, next year there will be a partial impact in terms of the corporate tax, and from FY23 onwards, we will be fully paying the taxes as what the bottom line implies.
So FY21 and FY22 will be 0% in the P&L also, right? And
FY21 will be 0. FY22 would be, there will be an impact in terms of what we have projected for better part of the, I would say, year, there will be no taxes, but there will be a partial impact in terms of when we completely, I would say, set off our existing income tax losses. Next year, there will be a tax impact, but that will be minimal, but full taxes will come on from FY23 onwards.
Full means you will be 25% tax in FY23.
Correct.
And there will not
for the whole revenue, not for the whole profits. Portion of the profits will be at that rate.
Okay, so which means FY24 you move to full F25, and from 22 onwards there is slight increase every year. So there will be, let's say, some taxation in 22, going higher in 23, and then 25% in 24.
That's right.
I think that is right to assume.
Can you tell us what will be the taxation next year, if possible? 5%, 10%, 15%?
So in fact, we would want to park that because it will be let me say that it will be around 5-10% in terms of the tax we are projected.
Okay, thank you very much.
Thank you. The next question is from the line of Prithvi Raj from Unifi Capital. Please go ahead.
Sir, how are the initial trends in Q4 of FY21? Because you would have some season sale during the New Year Eve, right? And also the Pongal season.
Yeah, the January month was very good for us. We have concluded the January month. And we are continuing to have the same kind of demand. And we are able to execute the demand at the same levels that so far in the 9 months that have been demonstrated.
Got it. And what about the sustainability of the current margins that we are seeing in Q3? Do you think you'll be able to sustain the same in FY22?
So actually, it's a function of the operational lever. So for us, currently, we are at about 2x of our break-even number. So 80% of our gross margin moves to EBITDA beyond the break-even. And so we believe it will be in the same range.
Right. Sir, and on the exports part of the business, you said that it is growing faster than the overall business. Can you throw some light on the key partners you are working with in that particular segment? And what is the breakup in terms of their share in the overall export business?
So for our OEM exports, they contribute about 7-8% of our revenue. And overall exports, about 10%. And as I mentioned, we work in about 12 countries under our Pigeon brand. And the North American market and Mexico, we work with the large retailers there. Of course, very specifically, if you want to know about the names of these retailers, Walmart is our largest customer. And then we have JCPenney, Belk, and Big Lots.
Okay. And what are the reasons why you are seeing this particular growth in this particular business, sir? Because are you replacing any other players like a Chinese players, or is it an organic expansion?
It's an organic expansion.
Okay. And how sustainable is this growth trend?
Yeah, see, we have a unique capability to produce these products at the price that we are able to export globally, being globally competitive. And the technology that we have is unique, very unique to us. So our cost structure for these manufacturing these non-stick cookware is different from the traditional way of manufacturing non-stick cookware. And our focus is to only be in the non-stick cookware export business.
Okay. And the margins in the export business will they be in line with your overall business?
Yeah, if you will set off the costs that are attributed to the brand business, we are at the same same margin level. But of course, the export business does not have any other costs, substantial costs that we incur in the various other costs that are attributed to the general trade business, that brand business.
Right, got it. That's it from my side. Thank you.
Thank you. The next question is from Vinod Jairam from Composite Investment. Please go ahead.
Yeah, good evening. Sir, your majority of the sales seem to be coming from Pigeon brand, if I'm right. More than 80% is contributed by that single brand. Is that right? And if that is so, are we underinvested in the other brands, namely Gilma and Black & Decker? Going forward, can we see some traction in those brands as well? What is the strategy out there?
Yes, so you're right. Currently, Pigeon is contributing a large part of the company's revenues. Having said that, I will answer about Black & Decker. Black & Decker, the agreement was signed in 2016. We started in 2017. It's a 10 plus 10 year agreement. We have built a very robust portfolio. We have also built a presence in 9 states across 1,000 retailers. So we are definitely poised for good traction coming forward, given that the product portfolio is well equipped. We are also going to start manufacturing. So yes, you will definitely see renewed focus and growth in Black & Decker. In terms of Gilma, while the brand is established around the same time as Pigeon, during 2012 to 2017-18, we took focus to come out of the oil company business and put our focus in increasing distribution of Pigeon. Now that Gilma has a very good presence in the south of India through 65 outlets, we believe this is the right time to take Gilma also across the country. Gilma's portfolio is largely chimneys and hobs. We also believe with modernization and urbanization across the country, we will see good traction if we are able to take Gilma pan-India. So yes, you will see again increased presence and increased focus on Gilma and Black & Decker as well.
Got it. Great. And what is the reason for having different distribution channels for each of these brands? Because they seem to be overlapping product segments in each of them. And is there a positioning difference among these brands? Is that why you're having a different distribution setup?
Yes, definitely. Pigeon is our value brand. We will definitely retain that value proposition for Pigeon. The second is Gilma, which is semi-premium, and third is Black & Decker, which is the most premium. So that is the tiering and the laddering which caters to different consumer segments. So while a particular product in Pigeon will have certain features, a Black & Decker product will have plus features for the same kind of utility. Example can be a toaster oven. So you are absolutely right. It is that is the difference in the way it is positioned.
Okay. And in terms of growth, I mean, if I look at the last couple of years, you have probably grown at 20-odd%, and currently at 40+%. So what has changed in the last couple of quarters? Is it the initiatives which you have taken earlier that has contributed, or is it a pent-up kind of thing which has also contributed into the last couple of quarters? So if you can help with that 40% kind of growth currently.
Yeah, it's a combination of the demand and the capacity. So there has been a continuous enhancement in our capacity. We have automized various lines, and also the demand and the growth in the various channels. Particularly, as I mentioned, there is a very high growth rate in the e-commerce channel, which 4 years back does not exist for us. So it's a combination of all these three, I can say: the channel, the capacity, and the demand, the consumer demand.
Okay, and finally, I wanted to touch upon the online. I think the 30% which you have mentioned seems to be one of the highest for a consumer appliance or durable brand segment. So what has contributed to that kind of high growth in the online segment and contributing to almost that kind of revenue? And corollary, I mean, the question related to that is how are the margins in that particular segment compared to the offline segment?
So one of the key benefits that we had was we were the first movers. We had the first mover advantage. We were very early on onto the e-commerce bandwagon. We believe that technology is going to drive the future consumer, and hence we came onto e-commerce very, very quickly. Second, if you look at Pigeon as a positioning for the brand, is value positioning. So that has helped us. When the consumer is moving from an unorganized, unbranded product to an organized branded play, Pigeon becomes the brand of choice because of its quality. Over the years, as we were present on e-commerce, we have worked on digital marketing, we have worked on our customer service, And if you see the ratings and reviews of most of our products, that has created a ripple effect where the number of people reviewing it and the rating, despite the large number of people reviewing it, has created a positive rub-off effect on new consumers that come onto the platform. So when someone searches for a pressure cooker and they see that a Pigeon pressure cooker has more than 1 lakh people who have reviewed it and it's 4+ rating, there is a natural tendency for people to buy. So all of this has been an effort of over last 4-5 years where we have capitalized on our value positioning, worked hard with the team and ensured that we cater to the consumer on the e-commerce platform.
Okay, just on that, the margins.
Yes, so as an organization, we are a cost-plus organization. So our pricing is channel agnostic and product agnostic. We make sure that after our landed cost, we levy a common gross margin that we require on top of our cost, and at that price, which is called MRP, minimum realization to the company, that becomes the invoice price to any channel, and then the channel margin is levied on top of it. So in short, it is product agnostic and channel agnostic. Our margins are the same.
Okay, great. Thanks for your answers.
Thank you.
Thank you. The next question is from the line of Hiren Trivedi from Axis Securities. Please go ahead.
Yeah, thanks for the opportunity. So just one question. You mentioned imports, raw material imports from China. So how much of your raw material is imported from China? And is there a specific product which is 100% made in China and it is traded by you through your outlets?
Yeah, so both imports contribute both the raw materials that go into the manufacture of our various products, and also we import completely built units based on our specification and quality standards. As I mentioned, of our overall revenue, that is the finished goods, 80% today contributes from manufacturing in our plants, and 20% is from these traded goods. So you can attribute this majority of this coming from China. We have a very strong team which with our office in China and which takes care of both continuous development and the supply chain management, including the quality assurance. But we are progressively moving towards indigenization of all these products. It's not that it will happen very soon, but it is a continuous process. There are some products which were 100% imported from China. Say example, I will give you. Glass lids for our non-stick cookware are 100% imported from China. We have put up a automated line for manufacturing of these glass lids, which will be operational very soon in the next, say, 30 to 45 days, which will completely eliminate this category of import for us. So similarly, we are continuously working on indigenization of these products.
Thank you, sir. That helps.
Thank you. The next question is from the line of Anurag Goel from Ampersand Capital. Please go ahead.
Yeah. Thanks for the opportunity. Just wanted to understand the capex plan for next 2 years. If there is any.
Yeah, we on an average have been investing about 20-25 crores in the past, and the advantage with Stovekraft is we had the land reserves already, which contributes a substantial cost for any capex. We need to put up lines and of course build sheds. So we believe that in the same range, between 25-30 crores every year, we'll be investing on capex that includes our tooling and maintenance capex.
But apart from this 25-30 crores every year, there is no major capex that you plan for next 2-3 years.
Yeah, that's good enough for the kind of business that we are in.
Okay. Understood, sir. Thank you.
Thank you. The next question is from the line of Sunil Kothari from Unique Asset Management. Please go ahead.
Thanks for opportunity, sir. Sir, my question is I'm ignorant about companies, so if you can a little bit explain what has changed during last 4-5 years. We were doing some 500 crore plus top line, but making losses, and now from negative operating to 5% EBITDA and now 15%. So broadly, this journey, if you can explain, it will be very helpful.
Of course, while this is a past, I would want to take you through this journey. The company was in three segments of business. We had a co-branding arrangement with the oil companies. We were also having large opportunities with the government government business and the brand business. Over the years, from more particularly from 2013, we completely came out of the government business and started tapering down the co-branded business with the oil companies from 2014. So what used to be a 250 crores of business in 2014 for us, the oil company business, as it stands in the last year, not the current year, the last year we were at only 20 crores and we are moving towards the zero. So while we were recalibrating this business, there was a fixed cost for the company. You will see that the top line looked to remain normal, but it was not so. We were actually letting go the co-branded business and building our brand business. So the net growth, whatever you could see on the top line, is only after setting off the let-gone business from co-branded business. So the margins in the co-branded business were not in line with the branded business, and the control on the business is also not like how we control our brand business. So that's a big change that has overall transformed the bottom line numbers of the company. And as we have hit the operational leverage, so there was a time that we were very close to the cost structure, the way the company was built. We were very close. Our break-even point was very close to the revenue numbers that we are making. But now we have moved to a 2x, I can say, currently, because our costs also we have worked on our costs, and also the revenue number has gone up. So with that, even the bottom line numbers now look healthy.
Mm-hmm. Great, sir. And sir, what is the promoter stake after this IPO?
It's about 54%.
50%. Thank you. Thanks a lot, sir. Thank you.
Thank you very much. Due to time constraints, we'll have to take that as the last question. I would now like to hand the conference back to the management team for closing comments.
First of all, thank you everyone for joining us. I hope we had been able to answer all your queries. We look forward to such interactions in the future. Once again, I would like to thank the investor community for the tremendous support shown during our IPO. We hope up to the expectations of you all. In case you require any further details, you may please contact us or our investor relation partners, Orient Capital. Thank you.
Thank you very much.